Before I forget, before I start this video today, I wanna remind everybody to have a wonderful Memorial Day weekend. God bless our military. God bless the people. Rest in peace who gave the ultimate sacrifice so that we could all be here today. God bless their families. A lot of people died for this country and gave the ultimate. And we don't have to agree with everything this country has done or stood for. But at the end of the day, this is the greatest country on planet Earth. And thank God for our soldiers, the people who gave the ultimate sacrifice. Thank you to their families and to all those soldiers. Rest in peace. God bless you. I hope that we never have to go into a major war again. I hope that what's happening right now settles down. War is a terrible, terrible thing. It's taken a lot of lives, and it is a very atrocious event. And thank God we had people who defended this country, went to war, and gave us an incredible life. And I think we owe it to the people, especially those people that gave the ultimate. We owe it to them to not let America fail and not let America just go down without doing something, without fighting for it. This is still the greatest country on planet Earth. It is worth saving. It's not perfect. I don't like the way it's being run, but it is still the greatest country on planet Earth. And thank God we live here. Thank God we were born here. The people who weren't born here and made it here did it the right way. They did it for a reason, because they know it's the best country on planet Earth, where they have more opportunity and more of a chance anywhere else. This is worth saving. We have gone downhill, no doubt about it. I understand that. Again, I don't like how it's being run, but maybe we can correct that. Maybe we can change that. But again, rest in peace to all the veterans that gave the ultimate. Thank you so much. God bless America. It's Thursday, May 23rd, 2024. Thank you so much for joining me today. We have a lot to talk about. I want to get into this video. Please make sure to like, share, and subscribe. Hit that bell notification down below also so that you're alerted when the newest video drops. But without further ado, let's just get right into it today. The markets did not have a good day. Most expected the markets to have a good day today because of NVIDIA yesterday, that this would really pull the markets up today, and it did not. Dow Jones down 605 points, NASDAQ down 65, 10-year bond yield sitting at almost 4.5%. That's the highest in 2 weeks. Gold down $60, $2,333 as I make this video. Silver down about $1.11, sitting at $30.32. Bitcoin down a couple thousand, sitting right around 67,000. So why did the markets get rocked today? Well, because they're beginning to realize that there is going to be no rate cut this year. Certainly, more than likely, not going to have one in September, and more than likely not going to see one this year. I believe that there's maybe a 5% chance that we see a rate cut this year, and probably more than a 5% chance we see a rate hike next year. So markets do not like the reality now that there may not be a rate cut. We got the jobless claims today. Came in at 215,000. That number was expected to come in at 220,000. That's not what they want to see. The Fed wants to see much more devastation in the job market. It's not seeing that. They're telling us wages are going up, GDP is going up, the consumer is resilient. Yes, the data is all a joke. It's all manipulated, but this is the data that the Fed is going by. And when jobless claims are less than expected, it's going to be very, very difficult for the Fed to justify any rate cut whatsoever. So on paper, everything looks fine. And so what's interesting is last week, the interest rate cut in September, there was a 70% chance last week that we would see a rate cut in September. That number today has fallen to 50, and that number realistically is much, much lower. It's very, very, very closer to zero. It's not going to happen, and I certainly don't think it's going to even happen this year. So markets now beginning to have to digest some amount of reality. And what happens if more and more reality sets into these markets? Are we going to see more days like we did today? I mean, these markets are hoping for one thing and one thing only. They don't care about your jobs. They don't care about job losses. They don't care about NVIDIA. It cares about rate cuts. That's all that these markets care about right now, is the cheap, easy money. Nothing else really matters at this point. Again, the markets don't care about your jobs, your standard of living, you being decimated in the middle class. The markets don't care you're paying more at the grocery store or the gas pump. All they care about is cheap, easy money and more quantitative easing. I apologize. There is some snoring going on today. Nugget is taking her afternoon power nap. Another article today coming from The Hedge. The old money secret to wealth. If you get 5 minutes, go to The Hedge, check this article out, The Old Money Secret to Wealth. The Colonna family from Rome, Italy, with a 900-year-old fortune still intact. How do they do it? Well, one of the members of that family said, easy, this is how we did it. 1/3 art, 1/3 gold, 1/3 land, diamonds also you could include in that. They survived Black Death, the 30 Years' War, the wars of Louis IV, the Napoleon Wars, both World Wars, the Holocaust, and the Cold War. Why? 1/3 art, 1/3 gold, 1/3 land. Interesting. They're not saying that they're ruling out stocks and bonds and all that. Great, but they said this is how our fortune has lasted over 900 years because of these three things. I thought that was pretty interesting. Art, gold, and land. Very fascinating. So if you get a minute, check that out. Here's one from CNBC. JP Morgan CEO Jamie Dimon says, can't rule out hard landing for the U.S. Stagflation will be worst outcome, he says. He also says rates could go up. Interest rates could go up. Now, this is where he loses me because he always says this. The consumer's in good shape. To me, when he says that, he loses a lot of credibility. I wish Jamie Dimon, he says some good things, but he also says some things like this, that the consumer's in good shape. He has to know, we know the consumer's not in good shape. He has to know the consumer's not in good shape. He runs the biggest bank in the United States. He warned the world is not prepared for higher inflation. He's right about that. The question is, are you prepared for higher inflation? Most people are not. They're still running up massive amounts of debt. They're still living a lifestyle they cannot afford. They're buying things they cannot afford. They're spending money they don't have. And the longer they do that, the longer and more susceptible to being a debt slave they're going to become. Very, very dangerous behavior if you're doing this. This would have to be the worst possible time in U.S. history to be running up debt with this nightmare that is right around the corner. Sales of newly built homes tank in April as prices and interest rates rise. Sales dropped 4.7% in April compared with March, down 7.7% year over year. New home inventory, I thought this was interesting, up 12.1% year over year. Remember, with the home builders, what are they doing? They're buying down mortgage rates. They're doing mortgage buy downs. They're cutting prices of these homes, and they're throwing in incentives, anything they can to sell these homes, to move these homes, while the existing home seller is sitting on the market longer and longer and longer, waiting and hoping that 2022 is going to come back around. It's not going to do that. But interesting that we're seeing more inventory picking up, and we're seeing sales dropping with the incentives, with the price drops, with the mortgage buy downs. So I think we're going to see more inventory of existing homes and more inventory of new homes hitting the market. We know that there's been a lot of construction over the last year, a lot of these homes coming on the market now. And the problem is you have a pool of qualified buyers shrinking because they're losing jobs, their credit's being destroyed, they have too much debt, and they don't have enough income. They don't have enough income where the prices are and where mortgage rates are today. The problem that I see is not really the mortgage rates. These mortgage rates are normal. This is where they should be. The problem is the homes are so overvalued that when you put normal mortgage rates into the scenario, it's absolutely impossible for most people to buy a home. So what I think is going to happen, and I don't know when. This could be a year from now. It could be 2 years from now. It could be 2 months from now. Prices are going to come down. You're already seeing this at the car lots, the truck lots, where prices are beginning to come down, used cars especially, because they're sitting on so much inventory now. Nobody can afford to buy this stuff. And a lot of people are just saying, I'm going to keep what I have. The average car on the road now is 12 and a half years old. So all the FOMO is drying up, and we still have some FOMO in the housing market. That's going to dry up too. The car lots are absolutely packed with vehicles. You're going to see this in real estate too, probably in the next 12 to 18 months, where inventory is just going to pile up. And the question is, who's going to buy all this? I mean, BlackRock can only buy so many homes, but where's the consumer going to be? Where's the first-time home buyer going to be? They're not going to be able to afford this stuff. So something's going to give. Either we're going to get mortgage rates back to 2 to 3%, which I don't see happening, or prices are going to come down, or we're just going to have a lot of houses sitting on the market. At some point, when people lose jobs, when people cannot keep up with inflation, their wages are not going up, but they're going down, and they can't afford the insurance on the property, let alone putting groceries on the table, they're going to be forced to sell. And of course, you have a lot of short-term rentals, people that got into VRBO, Airbnb. Those homes are not renting now. They're falling behind. Those homes will be coming on the market. And of course, I think you're going to see a pile of homes going back to the bank, and you'll be seeing REOs coming back to the market at some point too, but that's farther down the road. Another one from the hedge: existing home sales tumble as home buyer confidence hits record low. We talked about this yesterday. Existing home sales down 1.9% year over year, down 3.7% month over month. So we're seeing this in existing home sales now, just like new home sales. And mortgage applications for to purchase a home were down around 11-12% year over year also. Another one from the hedge: U.S. initial jobless claims refuse to budge from near record lows. According, it says, to the magical data, 215,000 Americans filed for jobless benefits last week, as we said earlier. Magical data. That's what it is, magical data. If you live in the real world, you know that this data is preposterous. And again, it's magical. It's fairy dust. Maybe we're going to begin to see the real data in November. Wouldn't that be interesting if all of a sudden now the real inflation numbers, the real jobless claims, the real unemployment numbers, all this, we begin to get like real data in November? What are the odds of that? Comment down below. Fox Business: retirement account balances hit highest level since 2021. This sounds really good, really encouraging. But the next article, also coming from Fox Business, which was just a couple lines farther down: retirees forced to return to work as inflation eats into savings. It's just not enough, they say. Rising costs of gas, groceries, utilities, car insurance, etc. It costs $10,000 to $12,000 more per year to live than it did 3 years ago. This is on the same website. Literally 5 articles down. 1 minute they're telling you that retirement accounts are hitting all-time balances, but then five lines down, retirees got to go back to work because they can't afford to live. Since 2021, food is up 21%, shelter costs up 18.3%, energy prices 38%. Maybe these people have some money, left in the retirement, but they're burning through it so fast that they have to go back to work. And this is really concerning because Social Security, we're going to take a major haircut in 2035. Who knows where inflation will be in a couple years, and they're going to have people working till the day they die just to afford to feed themselves. This is where it's all heading. Where did all the Social Security money go to? Why is there no accountability? Why is there no investigation? Where is the money? How come we have money to pay for all this college tuition debt that we did not sign up for? How come we have all this money for military bases and wars, etc., but we don't have money left in Social Security? It's running out in 2035. Don't you think that maybe this should be a priority before anything else? Sudden container crunch sends ocean freight rates soaring, setting off global trade alarms. This on CNBC, here we go again. Now another supply crunch. An ocean container capacity crunch has hit global trade just as the peak shipping season starts, with freight spot rates up some 30% over the past few weeks and heading higher. Bad weather, longer ocean transits, and vessels skipping ports are adding to the supply chain issues. Rates could rise through June, and the dramatic rise will surpass the Red Sea spike. This is going to hit consumer prices. This is extremely inflationary. What we're doing with our strategic petroleum reserves, now this shipping container crisis that we have, shortages, all the money printing, paying off the student loan debt, all this student college tuition debt, billions of dollars of college tuition debt. This is all inflationary. This is all going to continue to throw gasoline on the fire. We're printing up all this money, sending it all over the world. We're taking care of people from all over the world, paying off these obligations, this debt, interest on the debt of $1 trillion a year. Where is all this money coming from? We're printing more money. We're borrowing more money. Extremely inflationary. And again, you're paying people's obligations off, billions of dollars of college tuition debt, and we're on the hook for that. How is that not inflationary? And now we have another container issue. Massachusetts risks losing $1 billion as wealthy flee for lower tax states. The wealthy are leaving Massachusetts, just like they're leaving California, just like they're leaving Chicago. Since 2013, 39,000 have left. If the trend continues, more than 96,000 residents, making a cumulative $19.2 billion in adjusted gross income, will leave by 2030. The Bay State already has lost $821 million in income tax revenue since 2011. Wow. That's just one state. You're going to see this happening more and more. You are. Again, California, another example of that. How much tech money, how many upper middle class, wealthy millionaires and billionaires have left California? Elon Musk taking Tesla to Austin, Texas. It's happening every day. And so when you look at the tax revenue leaving, on top of that, think about not just the tax revenue of these people, but when these big office buildings leave or these factories leave, the tax base of these companies, when they shut down and leave these big vacant buildings behind, what does that do to a city or a state? But yes, a lot of, when these people leave, they're bringing their tax revenue with them and leaving these states. And when you have big companies that shutter their buildings, and now you don't have that large commercial building that is paying an enormous amount of tax in that city, that's another big problem. Who's going to pay for the police, the fire, the pensions, all of that? And of course it affects smaller businesses in those areas, like the little mom and pop restaurants, the hair salons, things of that nature that rely on these bigger companies being there. And so we're going to see more people get out of areas where they're being taxed to death. And this is going to be a big problem, just like Chicago. How many people, how many millionaires have left Chicago, taken their businesses with them, more vacant buildings, less money for the police, less money for fire, less money for the school systems and all of that. So I can't even imagine what some of these states and cities are going to look like 5 or 10 years from now, because people are so sick and tired of all this. They're just going to leave, and they're going to go where somebody welcomes them, gives them a tax break, where it's not so restrictive, where there's not all this bureaucracy, and so, I think that's a great way that you can vote with your wallet, right? That's what people are doing. They're voting with their wallet. If they don't like a school system, if they don't like what's happening in their city, and they can move, they're going to move, and they're going to put their kids in another school, and they're going to pay taxes in another state, another city, and we're going to see a lot of people doing that, as they're discussing right now, probably tonight at the dinner table, of how they're going to leave where they're at, when they're going to leave where they're at. I mean, these are very serious conversations taking place now in many states in America where people feel they're being absolutely strangled by taxation and some of the laws that some of these states have. So, whether you're, right, left, blue, red, whatever, people are going to have a choice to go where they want to go and be in a state that they want to be in. And I think that we're going to see a lot more people voting that way. So I want to leave it there today. Just a few things I wanted to share with all of you. What the markets do tomorrow, I have no idea. I don't really care because they're just so manipulated. But at some point when people just don't have the discretionary spending ability, these corporate profits, you can manipulate the markets for a while, and they've been doing it for a very, very long time. But when people don't have money to shop at these corporations, then we begin to see corporate profits shrink. And then we're going to begin to see profits or problems in these markets. These markets have had so much money injected into them. Let's not forget about all the corporate buybacks, all the trillions of dollars that were dumped into these markets. But at some point, it's all going to be running out as the consumer can no longer really afford to buy what they once did just a couple years ago. And so when that happens, look, we're going to see problems in the stock market, the bond market. We're seeing an apocalypse in commercial real estate. We're going to see an apocalypse in existing home, new home real estate, residential real estate. It's all happening because it boils down to this: money. If you don't have a job, if you don't have enough income, you cannot buy this stuff. Even when prices come down, people's credit will be so destroyed, their bank accounts will be wiped out. They'll have nothing to even take advantage of the sales that will be coming. And that's really, really sad. And that's why I've been making these videos for years, so that you build up your war chest, so you continue to prepare for what is coming. And let's not forget this: it's not going to just be an economic collapse. We're witnessing a social collapse take place at the same time. And the worse the economy gets, the worse society gets. So make sure you're protecting yourself, not just your wealth. Make sure you're protecting you and your family. So I'm going to leave it there. Have a good day. I do want to wish everybody a very good weekend. Have a good Memorial Day weekend. God bless all those people that gave the ultimate. We would not have this country without them. So God bless the veterans. God bless America. Thank you so much. Keep your head on a swivel, ladies and gentlemen. A lot of things happening. Be careful out there. God bless.